the growth of passive strategies in the market has changed the underlying market structure significantly enough that I think it's absolutely critical that people are both aware of the issues and aware of possible solutions to protect their portfolios.
Well, Mike, thanks for joining us today. I appreciate the time. What a day to be joining us. Market's down about 4%. S&P's down 4, I think, or no, the NASDAQ's down close to 4.5% at this point. So thanks for taking time out of your day. I was going to read off your bio, but it'd probably take up half the podcast. So I was wondering if maybe you could just give us maybe a 2-minute snippet of where you're at right now and maybe how you got there or what led you to Simplify ETFs.
Sure. So I am in my home office. I got here through the stairs. So I am the chief strategist and portfolio manager for a firm called Simplify Asset Management. We're a new ETF firm that launched in September of 2020. The opportunity to do that launch was created by a change in the regulatory framework that allowed the introduction of ETFs that incorporate derivative strategies, derivative overlays, which has been my area of expertise in the past. We've been very fortunate to have grown rapidly, and a lot of the products that we offer are designed to take advantage of some of the features and changing market structure characteristics that we'll highlight here. Prior to Simplify, I've been involved with hedge funds for years, most notably a firm called Canyon Partners, which is a roughly $30 billion asset manager based out of now Dallas, previously Los Angeles, where I had built and founded and built out the New York office for Canyon Partners. And then after that, managed my own firm with allocations from the Soros family or the Soros Foundation, and then had managed Peter Thiel's capital in macro strategies, and transitioned into the ETF space when it became apparent that we could do so. The really critical dynamic is this rule change in ETFs allows greater tax efficiency behind derivative strategies, which is something that has historically been challenging for the high net worth and ultra high net worth families that I've managed the capital for on a derivative overlay framework. So a lot of derivative strategies were uniquely suited for institutions that had tax advantage status, things like pensions, et cetera, or endowments. With these rule changes, it becomes easier to deploy it into the retail space. And as we'll go through this, the growth of passive strategies in the market has changed the underlying market structure significantly enough that I think it's absolutely critical that people are both aware of the issues and aware of possible solutions to protect their portfolios.
Yeah, absolutely. That's one of the reasons I wanted to bring you on. Obviously, I'd seen an article on Bloomberg recently that mentioned roughly 54% of all U.S. equity funds investments are in passive vehicles at this point. And I know you've done a lot of research and a lot of vlogs and talks about how this passive is going to affect the markets going forward. I think kind of to table set everything, one of the things I wanted to kind of start out with is maybe how we got to this point, right?
Yeah.
I think as an advisor myself, when you look at the data, most of the data says, look, active is just failing at trying to beat the benchmarks, right? So the thesis with a lot of investors and advisors is, look, passive is going to get me exposure at a lower expense, obviously, and it's actually performing better than active. So why would I even go with active? But I think a lot of your research actually shows that there's some other underlying currents that's happening to this dynamic, right? And so I want to kind of dig into that, and then we can kind of go into market structure. So if you would, maybe just talk about some of these other underlying currents that are happening that's creating the rise in passive investments, above and beyond just performance, probably.
Sure. So the origin of the theory behind passive investing, that you can, instead of selecting an individual portfolio manager who's going to try to pick stocks that are going to outperform the market, right, in aggregate in the portfolio, it is the observation from Bill Sharp and others in terms of the construction of what's called the efficient market hypothesis, that if markets represent the sum total of information that is available,
Yep.
that any attempt to outperform is ultimately going to be somewhat futile, because the best information is already reflected, the aggregate of the best information is already reflected in the market in total, right? And so the dynamic of active versus passive received real impetus with the growth of the efficient market hypothesis, this idea that effectively you could buy all of the stocks in realizations, with the idea being you're just mimicking the best efforts of all the active managers combined.
Yep.
Okay. The problem with that analysis, and I'm going to actually share a slide to highlight this for people.
Just like Sharp's arithmetic, right? Paper.
Correct. This is the arithmetic of active management. And so just very quickly, apply, Simplify and myself have nothing useful to say, and you shouldn't pay any attention whatsoever. The challenge in passive management is, if I go to the paper in 1991 from Bill Sharp, the arithmetic of active management, and just to set the stage here, at this point in time, passive is about 0.5% of the market, right? So basically a pimple on the elephant's ass.
Yeah.
The definition of passive in that paper is really important, because what he describes is a passive investor always holds every security in the market, right? And an activist investor is simply one who is not passive. Okay. Now the problem is, how does a passive investor get into the market? If all they're doing is holding, there is no mechanism for them to transact. The minute they transact, they cease being a passive investor and they become an active investor who influences markets.
Okay.
Okay.
Yep.
So what we actually have with passive investing is not passive investors. And by that, I don't mean, the S&P selection criteria, or, you as an individual choosing to market time the market. I mean, every possible incarnation of passive is not actually passive. It is active. It's just operating off of the world's simplest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell.
Right.
Right. And that very simple approach has created conditions under which people presume that it has no impact, but it actually has a giant impact. Hence the title, The Greatest Story Ever Sold.
Okay.
Right. I mentioned the dynamics of scale. This is actually from a Morningstar analysis and is fairly common in terms of the way people think about the market, right? So this is looking strictly at mutual funds and ETFs. It's showing the growth in terms of the assets under management for passive, and going from basically nothing in 1995, less than 2%, to today of managed assets, as you point out, it's in excess of 50%.
Right.
Right. Now, those numbers, when you hear them presented to the public, people will then flip that around and say, well, really managed assets are only about 40% of the total market. So 50% means 20% passive, but that's ignoring every other aspect of passive, particularly on the institutional side, in which actually passive originated first and has far greater share. And so it eliminates things like commingled investment trusts. It eliminates things like the endowments that run a total return swap. It eliminates futures, et cetera. When you incorporate all those components in, you end up with somewhere, on my analysis, around 40 to 45% of the market being passive at this point in the United States.
Okay.
So this has become a really, really critical dynamic in terms of the share of the market. There's also a misunderstanding in terms of why this has occurred. And yes, there is an element of outperformance, both for the investor and for the portfolio, right? So the lower cost of passive portfolios has been a benefit to investors, as has been the outperformance that occurs in most situations. But there has also been huge regulatory framework changes that have assisted the growth of passive, because it's presumed to be this innocuous, benefit to consumers,
Right.
to end users. The most important ones I would highlight are the Pension Protection Act of 2006. This introduced what's called the qualified default investment alternative in 401ks. Prior to
QDIA.
2006,
Yep.
if you had invested in a 401k, it was incumbent upon the user, the actual 401k investor, to make an asset allocation, to choose what assets to invest in. The complaints under that framework, and this fell into the behavioral finance category, were that many people failed to make any choice whatsoever, and so they were left holding cash. They would invest into a money market initially and then never reallocate, and so they did not benefit from the investments in the market. In 2006, with the introduction of QDIAs, the qualified default investment alternatives, that changed, and suddenly the human resources manager that onboards you into the benefit plan is responsible for selecting the qualified default investment alternative. Initially, those began as balanced funds, so something like a 60-40 equity allocation, things like the PIMCO total return products, et cetera, that mix things together were big recipients there. And in 2012, the qualified default investment alternatives almost universally shifted due to another regulatory change to what are called target date funds.
Okay.
And most people are familiar with target date funds, but target date funds are effectively fund of funds that allocate almost exclusively to passive investment vehicles in a fixed proportion that's referred to as a glide path tied simply to people's age.
Right.
Right. They make up about 85% of the marginal dollars that are now going into 401ks. And under most estimates, most people never change those allocations, the same as the cash dynamic. This has even lower change frequency. And so it creates a giant homogeneous mass, effectively a sovereign wealth fund we call the US retirement system, in which people are increasingly behaving as one entity, all buying the same underlying products.
So you had mentioned 85% of every dollar basically is going into these target date funds in 401ks.
401ks, yes.
Okay, very good. All right. So you have this big dynamic of all this money going into target date funds. You have the average investor, a lot of advisors now switching to active, but one of the things you pointed out here is a lot of this is kind of regulatory stuff that happened on the back end, that it's not just purely outperformance or low fees at this point, essentially.
Well, and there's multiple issues associated with that, right? So one is there's definitely the outperformance issue that creates a feedback loop in which people see the outperformance, they choose to allocate to passive strategies because no rational human being wants to underperform, right? Like that's, tilting at windmills. So we have a feedback loop that is created and spurred increasingly rapid adoption, but at the same time, the regulatory framework is basically guiding people into this path. It's creating an underlying condition in which all of the money that is going into the markets is going in passive framework, right? And all of the money that is coming out is coming from discretionary managers. Now, John Bogle himself addressed this and said, look, if everybody indexed, the only word you could use is chaos, catastrophe, the markets would fail, right? What Bogle failed to consider, and I think it's important, like if you read the literature around Bogle, it's not that he was a proponent of passive per se, he was a proponent of low cost investing. And that I think is actually really critical. And at Simplify, as you know, Chris, we've worked really hard to keep the costs of our funds below the traditional industry standard of 50 basis points that are more consistent with the passive vehicles, because I totally agree with that. But the scale of the operations of the Vanguards, BlackRocks, et cetera, and the ancillary activities like securities lending that they're engaged in are allowing them to offer products that are increasingly at effectively zero cost, removing the capacity for many advisors to offer anything else to their clients, because they themselves then run the risk of being accused of steering their clients into high fee products, right? So again, that feedback loop is underway.
Yeah. Yeah. So we've kind of got the general thesis of how we've gotten to this point and
Yep.
possibly how it's going to keep going, right? So let's talk, maybe switch gears a little bit and talk about how this is going to actually affect the underlying structure of the market, right? I think you have maybe 4 or 5 kind of main points that you've talked about in the past of how all of this. Oh, there you go. Perfect. So yeah, why don't we jump into this, Mike, and we can kind of attack the correlation first, obviously, and
Yeah.
kind of go point by point, if you would.
So if we run point by point, I'll just read this out in case somebody's listening rather than watching or has
Sure.
trouble seeing a smaller screen. How would we expect passive investing to impact markets? Well, the first is obviously if everybody's buying and selling everything all together, you're going to see an increase in correlation, right? You would expect securities within an index to increasingly behave like each other. The second one, and this is one that is less well understood, is that if you move to passive investing, if you move to index investing for a variety of reasons, you end up with increasing valuations of securities. And I'll walk through the mechanics of why that occurs. But you effectively create conditions under which markets become increasingly disassociated from the underlying fundamentals, which echoes a complaint that we hear quite frequently these days, right? Markets
Yeah.
feel like they're crazy, completely
Yep.
disassociated from the underlying fundamentals.
GameStop.
GameStop, perfect example, right?
Right.
The next one is that what's referred to is elasticity, right? So elasticity in an economic sense means the change in supply and demand or the change in price related to a change in supply of demand, right? So an inelastic product or entity is something that changes dramatically in terms of a change in supply or demand. An elastic component or an elastic security is one that changes very little in response to that. Now, historically, the assumptions on things like the EMH, the efficient market hypothesis, are that equity markets and fixed income markets have very, very high levels of elasticity. You can mechanically understand why that is because every buyer has a seller. We hear that language all the time, right? So you buying and me selling, theoretically, we're crossing that shouldn't have that much of an impact.
Right.
But the literature is actually increasingly disputing that type of analysis and suggesting that the market has much higher inelasticity. The elasticity is much lower than the EMH would assume. And the growth of passive, there's a professor at UCLA who's done a fantastic paper called How Competitive is the Stock Market? His work is suggesting exactly as mine does that the rise of passive is causing increasing inelasticity of the market. In other words, raising the risk of extraordinary price movements. Today, May 5th, 2022 could not be a better example of that,
sure.
Right?
Right.
There's also a component in terms of increase in market concentration as a momentum bias leads to the largest companies becoming larger. Now, this has real world implications. We absolutely have seen this where the Apples, Microsofts, et cetera, have become increasingly dominant within the S&P 500 or the US equity markets. But I also want to highlight that when that occurs, when you see those companies becoming larger and larger and larger, it actually creates conditions that leads to fundamental consolidation because those companies then have a cost of capital advantage in the market that allows them to make all sorts of investments and do things that others might not be able to do. So it manifests itself as increasing concentration in the fundamental economy, not just the financial economy as well. And then the last one is one that actually is really interesting in the context of what we saw in the past 2 years, which is the reduced ability for new companies to become public. And just mechanically, you can understand how this plays out because a company cannot be included in an index or a market index until it is public. Getting something public requires discretionary managers to say, I'm going to take a risk on this company and move away from my benchmark to incorporate this new company into my portfolio, waiting for it to be included into the index portfolio.
Right.
As you reduce the quantity of discretionary active managers, you're reducing the market's ability to accommodate new companies coming in.
Competition on the buy side is being reduced for those new companies coming in.
Competition on the buy side is being reduced is one way of thinking about it. I would also frame it as the diversity of actions that can be taken on the buy side are being restricted.
Right. So Yeah, these points are definitely well taken. I'd like to kind of attack the correlation
Yep.
thing. I think a lot of we have kind of noticed correlations going up, but I know you've done some work actually showing the background of the correlations going up. So why don't we take a look at that if you got a chance, Michael?
Yep.
Yeah,
So
perfect.
one of the challenges is when you talk about correlation, and I try to highlight this as quick background just so people fully understand what we've done here, right? Um, correlation measures how much of the movement of variable Y is explained by the movement of variable X. When you start talking about large market structures, right? So 500 stocks or thousands of stocks within a Vanguard total market index, for example, measuring those correlations is quite difficult because you need a minimum of a 500 by 500 covariance matrix for the S&P 500. You need the instantaneous weighting components of it, et cetera, et cetera, et cetera, right? So the actual data that's available, you can see the black line. This is the actual levels of correlation, is a remarkably short data set that really only emerged following the global financial crisis.
Okay.
However, you can use a mathematical shortcut to get to almost exactly the same answer, which is what you see with the yellow line here. It's what I refer to as co-movement. So co-movement dispenses with all of that fun stuff in a giant covariance matrix and asks a really simple question. Did two stocks move in the same direction on the same day? Right?
Gotcha.
And carries that back over time. And what you find is it's the result of a mathematical property called Kendall's tau, or binomial correlation. You end up with the same answer.
Okay.
Right. So a shortcut allows me to build a much more robust data set that matches closely the observed data we have and allows me to go back further in time. And so while most people, as we came into the fourth quarter of 2017, were looking at a world in which correlation just appeared to have fallen from in the aftermath of the global financial crisis, my work suggested to me that we were actually extremely extended below an underlying rising trend line. Right? So the yellow has that green as its underlying trend. You can obviously see that the black would have a different trend in the shorter data sets.
Yeah.
Right. Now, the reason I highlight this is that this analysis sat at the core of a trade that I'm well known for doing with Peter Thiel, where we bet on a significant jump in volatility and more accurately correlation in the latter half of 2017 that manifested itself in what's referred to as Volmageddon, the collapse of XIV, right? So that was a trade that this analysis was done for. And the really critical dynamic in terms of, was the thesis wrong? What was actually going on? Is this is a secondary component, what I would refer to as conditional correlation. And so again, going back to the definition of correlation, it's how much of the movement of variable Y can be explained by the movement of variable X. There's two reasons why that correlation could show up as low. One is that there's no relationship, which is what people tend to assume. The second is I just don't move variable X very much.
Okay.
Right. And so, I try to explain this to people. If you think about crop yields versus fertilizer application, we all know that an increase in fertilizer application causes an increase in crop yields up to a point. Right. But if I don't change that fertilizer application very much, I'm not going to get a discernible impact on crop yields, right? So fertilizer application is measured in tons per acre. If I change it by ounces per acre, I'm going to come to the erroneous conclusion that it has no impact whatsoever.
Right.
And that's really what was going on in 2017, was that the markets themselves were operating under conditions of incredibly low volatility, incredibly low realized volatility. And so the share of days in which the S&P wasn't moving very much were very, very high.
Yep.
Right. And that's what was causing that observed low correlation.
So that's explaining that downward trajectory in that previous graph. Basically, is just we just didn't have volatile days during that time period.
Correct.
Okay.
So if I instead look at days in which the S&P moved on a more normalized basis, you can see that trend is actually even larger than the trend that I showed before.
Gotcha.
Right, with correlations roughly doubling over the period from 1996 until December of 2017.
So on high vol days, correlations are really spiking up, basically.
Yes,
Yeah.
100%.
Right.
And to really put numbers behind that, again, because I've used a simplified version, I can take this data sets all the way back into the 1920s, and suddenly I'm able to see the impact of passive investing and the growth of passive investing and how it's impacting the markets. And instead of having the very low correlation that other people saw in 2017, I saw high correlation and rising correlation. And in fact, on the day of Volmageddon, where the XIV collapsed and the trade that I had constructed had a payoff, for the very first time in history, we saw every single stock in the S&P move in the same direction.
That's interesting.
Right? It then happened 2 more times in the fourth quarter of 2018. It then happened 3 times in 2020.
Wow. So yeah, that's high correlation, basically, as correlations are becoming, and you would assume that that's because the passive investors don't really care about the information that's happening. They're either just buying or selling. Is that the thesis?
They don't
Or
care about the unique information, the idiosyncratic information for an individual company, right?
right.
So again, this is one of the opportunities in the aftermath of the pandemic, was many of the securities that benefited initially from the work from home type framework became very undervalued. If I think about it in that framework in March 2020, right? The stimulus was coming. Everyone was going to need a computer to work from home. Everyone was going to need an iPhone or a smart, capability. Everyone was going to need Zoom. Everyone was going to need home delivery, etc. So all of those became remarkably cheap relative to the stimulus that was about to be pushed through, even though most people did not see it in that framework.
Right. Okay. So this is also leading to valuations increasing, right? The passive
right.
stream.
So if we jump to the next part and talk about the increase in valuations, we need to take a step back and say, how do valuations work, or why have valuations historically exhibited their behavior that we've seen in markets, right? And so most people will immediately say, well, interest rates, right? And they'll say, low interest rates should lead to very high valuations. And there's some truth to that, although not as much as people think.
Okay.
And you can point to places like Japan, for example, or Europe, where interest rates were even lower than the United States, or the 1950s in the United States, in which there was both a fantastic growth trajectory and low interest rates, and valuations were roughly a third of what they are today. Right. So we don't have a lot of historical evidence that suggests that the interest rate hypothesis is correct. So I chose to attack this in a different way by actually going and surveying investors and trying to create effectively demand and supply curves for securities. I asked portfolio managers a fairly straightforward question. You're a portfolio manager, you have 5% cash in your portfolio, so cash is not a constraint in one way or another, and you receive a marginal inflow or outflow request. What is your behavior given valuations? And so I was surprised to discover that no academics had done this. Effectively, what I'm doing here is creating the marginal propensity curves that you remember from your econ in college, saying, what is your propensity to buy or sell given some type of valuation? And unsurprisingly, the results come out that you become increasingly willing to sell as valuations rise, and increasingly less willing to buy as valuations rise. Now, that feels fairly straightforward, and obviously these are best fit lines against a lot of observations, roughly 452 observations, but that's actually not the most important point. The most important point is actually this intersection, right? And so when you look at this data, and again, remember, all I've done here is surveyed 450 investors, but you have a really intriguing outcome, which is that the intersection between these types of investors hits at 50-50 at almost exactly the market's historical valuation average, right? And
right.
when you actually run a simulation where you create agents and you give them this type of demand curve,
Yep.
right? And so you can have some variations around it, but you give them roughly that demand curve, and then you randomly give them cash or take cash away. What you discover is the evolution of that type of market over time is mean reverting. In other words, valuations remain stable. Okay.
Yep.
Now the problem is when I introduce passive, remember the rules of passive are I have 100% propensity to buy or sell. And so the passive investors themselves have aligned at 100%. And as we add share of passive to the market behavior shifts. And so
Yep.
instead of being 50-50, at 50% passive, it's more like 78% is where they cross. And what this means is that the markets become increasingly flow sensitive as compared to valuation sensitive. And if I run that same analysis where passive is gaining share over time, what I end up with is rising valuations.
Because passive is just buying when income or when flows are coming in.
Anytime money comes in, and because passive is gaining share, it's perpetually receiving cash.
Right.
Right. So there's a perpetual buy that is occurring under the market.
Right. And I've seen an illustration once, and I believe you're the one that actually brought it to my attention. Was, the example of $1 goes into a passive fund, what happens with that dollar versus $1 going into an active fund. And that's kind of what you're showing here, I believe.
That's
right?
Exactly what's being shown. That's right.
Okay.
So if you think about an extreme example, right, a discretionary active manager faced with a market at record high levels of valuation could very well say, you know what, I'm just going to take the cash and wait for an opportunity to buy at a later date.
Right. Yeah.
Right. But a passive investor doesn't have that capacity. They're forced to deploy those funds immediately, presuming that somebody else is doing the thought process behind that.
The rest of the active investors are clearing the market for me, essentially.
Not just the active investors, but also the person who's allocating to the passive investor. It is presumed that they had some intelligence or thought behind their behavior. But this is where, when you enter into automatic investment programs through things like 401ks and target date funds, they have no filter on that. They literally don't stop to think about this at all.
Right.
And
yes.
So you're creating a Borg-like entity, right? Resistance is futile as money flows into these strategies. They're just chasing stocks higher and higher and higher and higher.
And so this kind of leads into the inelasticity of the market then, basically. Correct? Yeah.
Correct. And it also says something else to you that plays through. We talked about the inelasticity, and just very quickly, just to show the impact of this. If you actually look, again, here's the data set, right? So we know historically, this is why Robert Shiller came out with his work in 1996 around the cyclically adjusted PE ratio, right? The Shiller PE that everyone's familiar with.
Yep.
The market had this mean reversionary characteristic, but as we've introduced passive, what we've actually seen is that mean reversion has broken down. The market has become mean expansionary, exactly as these models would suggest.
Because you don't have active participants in aggregate selling at market tops and vice versa, basically.
Correct. Or failing to invest the incremental dollar coming into the market in the name of prudence.
Right. Exactly. Perfect. That's very eye-opening, to say the least. Now, this is also leading to kind of market concentration, right? You talked about Apple and Facebook.
Yep.
Yeah.
And it has reached such extreme levels. So if you look at the concentration, and by the way, this is dated, this is looking at the proportion of the S&P in the 5 largest stocks, right? So I just want to highlight, by the way, here is roughly where target date funds became the default investment vehicle, and completely removed a lot of these restrictions. But the underlying characteristic is twofold. One is, because I'm buying stuff in proportion to its prior price, right? So if something goes up in price, it gets more of the next marginal investment dollar. So I chase things that go up in price.
Right.
That creates conditions under which those securities should rise relative to everything else. And this is exactly what we're seeing here. The other component is that it again speaks to the importance of regulatory framework. And by the way, as I mentioned before, Simplify owes its genesis to a change in regulatory framework. So any idea that regulations don't meaningfully change market structure, like just put it to bed right now.
Yeah.
Part of the challenge and irony of passive is, because it is presumed to be so innocuous and because it is presumed to be so investor friendly, almost any action that is proposed in favor of passive or facilitating the growth of passive is adopted. And so in the fourth quarter of 2019, the S&P 500 had become concentrated enough, and more importantly, things like the S&P 500 Growth Index had become concentrated enough that they were technically in violation of the Investment Company Act. Right? They were too concentrated to qualify for what's called diversified fund status, and therefore they were ineligible to be marketed to most investors. So now the SEC, of course, faced with this, the index companies being faced with this, lobby the SEC and say that's ridiculous. And the SEC, of course, agrees, which then allows the next stage to kick in. And we've continued to see this type of dynamic play out over and over and over again.
So the exemption was saying, yeah, you could have conceivably a 10% allocation to Apple, for example, correct? And the exemption was just for index funds, or did they give that across the field at that point in time?
It is just for index funds.
Okay, perfect. So yeah, as index funds rise in popularity, this is just going to reinforce the cycle that you're talking about, essentially.
Correct. So it's unfortunately in what's called systems dynamics, is referred to as a positive feedback loop, right?
Yeah.
And a positive feedback loop just means that it amplifies itself. And unfortunately, we can positive feedback loop ourselves all the way to Armageddon.
Right. And I liked one of the things you said earlier, which I never really thought of, was essentially the rich are getting richer, right? Like you said, they have more and more money coming into Apple and Microsoft, et cetera. And the little players are not getting any attention, so to say, basically.
Yeah, I mean, there's a variety of things around that, but among other impacts that this has is when you start thinking about the implications, it means that Apple's cost of capital is going to be significantly lower than almost any other companies, or Microsoft's cost of capital is going to be lower than almost any other company. We see this in Google, Apple, Microsoft, et cetera. That facilitates them actually defending their existing marketplace positions, right? So engaging in behavior that could be broadly construed as monopolistic. It also facilitates them making acquisitions because they have such a low cost of capital, they can pay for almost anything, right? And perversely, if they issue stock to pay for something,
right,
it adds to their market cap and means that index funds have to buy even more.
Right. Yeah, that's a dynamic that I don't think a lot of investors or even advisors probably think about. And then lastly, I think that the last point you had is on IPOs, right? New companies coming into the market and how the rise of passive is affecting that market structure, essentially.
Right. So if we go into this model and we look at the dynamics of IPOs, we've broadly seen a dramatic decline in IPOs in the United States from 1999 to 2019. This manifested itself, if you remember the narrative around venture capital, well, they're just going to keep companies private longer, the public markets can't properly value them, et cetera. But that's actually a misunderstanding, because again, what's happening with an IPO is that a discretionary active manager is making a choice to deviate from their benchmark, incorporate something new where they trust management or they believe that this represents a unique opportunity for a business to emerge that could be potentially quite valuable, right? So we saw a continual decline, and then suddenly in 2020, we saw a radical change, and we saw SPACs explode, special purpose acquisition companies, right? Now, of course, the irony is that the language that emerged around SPACs was, well, they're a better vehicle because they allow these new innovative companies to use language that they otherwise might not be able to use in their description. So they can make forecasts or predictions that a traditional IPO could not do, right? I just want to highlight for people that we are a narrative species. We build stories to fit observations, right? So, and for thousands of years, among other things, we believe that the sun was pulled across the sky by a golden chariot steered by horses and a god, right? So, like, we'll believe almost anything. I just want to emphasize that. What actually happened with SPACs is that they were an index arbitrage dynamic. And so if I dig into the methodology of the indices, the CRSP, the Center for Research and Security Prices indices, are the low-cost indices that are used by players like Vanguard and BlackRock for their total market indices. If I dig into their methodology, I discover that special purpose acquisition companies, blank check companies, are not eligible for inclusion in the indices, right? They're effectively cash storage vehicles. They're not able to be included in the indices. But once they make an acquisition, if that acquisition of sufficient size, they become eligible for what's referred to as fast track IPO status. So a traditional IPO is not eligible for index inclusion for as long as a full year.
Okay.
But a SPAC can become eligible in as few as 5 days.
Okay.
Right. And so if you actually look at who the biggest buyers of many of the large SPACs, the Clover Healths with the Chamath Palihapitiya, what his name is.
Yep.
Right. Or the Nicolas, which are the outright frauds where they're rolling an electric vehicle down the hill. Right. When we look at who holds these and who have been the buyers of these types of SPACs, it's been the vanguards of the world that have stepped in to buy significant shares, creating upward share pressure, at least initially, as they're included into the indices.
So it's an index arbitrage almost type of situation.
100%, and nobody talks about it.
I've never known about that dynamic. That's crazy. Some people might give the argument though, Mike, that these SPACs are led by, I don't know, GPs or Chamath or whoever it is. Could you make the argument that they are being active in selecting the companies that go into the SPAC at that point?
Oh, 100%, right? That is absolutely the discretion of management. And so what they're choosing to do, and Chamath would be a perfect example of this, they're choosing to identify securities not on the basis of their fundamentals, but on the basis of, if I market this, will the discretionary holders of this buy in and not sell? All right. So you tend to pitch stories, EVs, or space exploration, or innovative health companies, right? It becomes all about this underlying dynamic of, can I create the conditions under which people buy into the narrative that despite high volatility, they should hold this because it's the future of X, right? So your objective is to effectively lower the elasticity, the willingness to sell, right? And create additional supply on changes in price. So it becomes a magnifying dynamic.
Right. It's a narrative, like you said, right? They're selling a narrative essentially.
100%.
Yeah. So we've gone through all these data points that you've shown, and very eye-opening. A lot of stuff, again, like I said initially, these undercurrents that are happening that I'm sure a lot of advisors or investors are not super aware of. With all of that in mind, I'm going to ask you kind of a hard question. How do we incorporate this stuff into asset allocation or investing going forward?
Yeah, so there's two things to really be aware of here. All right, the first is everything I just showed you has a really important implication in terms of how we think about the data that we see on active versus passive managers.
Okay.
Right? And so the way that we typically construct portfolios is that we look at the historical return stream associated with an asset over a very long period of time, right? So Ibbitson's, 1927 to current time series in equities. And we make some assumption that that is the underlying return for the asset class that remains relatively stable over time. And then there's cyclical variation around this. And so if I were to illustrate this, it's here's time, here's asset class return, and then there's cyclical variation around that.
Yep.
Right. However, if my theories are correct, what we're actually seeing is not that stable line, but a curved surface where the exponential characteristics of the growth of passive create higher and higher valuations and hence higher and higher returns given an underlying valuation over time. This literally this invalidates the Shiller type approach using that cyclically adjusted PE to suggest here's the return given valuations. At every step in this process, we're shifting it upwards, which again matches almost perfectly with the experience that we've seen where all the thoughtful principled investors who say, I'm not going to invest at these high valuations, get left sitting in the dust.
Alpha decreasing at that point, basically.
Well, and so the challenge is that if this is correct, it mechanically creates the perception that active managers are getting worse over time. And the reason it does is because what alpha actually is, it is the intercept in a y equals mx plus b linear equation, where m is beta, x is the market return, y is the portfolio return, and there's some unexplained skill component, effectively this intercept, right, that we call alpha.
Yeah.
The problem is if I try to use a linear solution to a convex surface, I create conditions under which, as I move forward in time, my alphas shift negative. My intercepts are forced lower. And this matches perfectly, the theory matches the observations.
Right.
We're seeing this not just in actively managed strategies, but any type of strategy that takes advantage of those types of historical relationships that presume certain things are in place. So here, for example, I'm indicating strategies that sell options, right? So call overriding or put writing type strategies. We're seeing the same mechanical destruction of excess return.
So yeah, there's nothing we can do then?
Well, we can commit ritual sepulchre, or we can take advantage of these features to do something quite different, right? And so what's occurring mechanically, I can illustrate it for you in two separate ways. The first is, if I do something as simple, and I always encourage people to do this, almost anyone is capable of doing this. If you simply download the daily returns for the S&P 500, the NASDAQ, the Russell, the VIX, et cetera, and I look at the distribution of those returns and the characteristic of skew, right? Effectively, how many adverse events versus how many positive events occur. What I am seeing is that the market, exactly as I would expect, is exhibiting increased inelasticity and exhibiting an increased propensity to crash on the left side while marching upwards on the right side, right? The inverse is true for volatility, which contributed to dynamics like the collapse in XIV.
So you're seeing a return distribution skewing to the left or negative, essentially, at this point.
Well, so what you're seeing when we talk about skew is a measure of how large the left, a negative skew is a measure of how large the left's tail is as a proportion of the total distribution,
right?
Versus a normal distribution that would be perfectly symmetric.
Equal. Right. So
but there's another feature associated with this. And again, there's this march upwards, and we can actually see this if we then outline the actual distributions, right? So this is looking at the daily returns presented in a framework of, effectively that normal distribution. What we're actually seeing is both dynamics are playing out. We're seeing more frequent, more severe adverse effects, but because we have this drift, that upward shift, we're experiencing on a frequency basis, markets look like they've never been healthier.
Right.
Exactly. This manifests itself as the types of impossibly high positive Sharpe ratios that we've seen from the S&P 500 several points over the past few years.
So smaller gains, but more positive gains, but bigger, larger drawdowns, essentially.
And correct. And importantly, it's that center of the distribution that has shifted. The right tail has not actually meaningfully shifted all that much, but the left tail is getting really bad. Right. So the point that the way I would describe this is we're in an environment in which the underlying structure of the market is such that it's like a roulette wheel that has become imbalanced. Instead of black and red coming up roughly 50-50, black now comes up 70% of the time. And when red comes up, they shoot you.
Yeah, that's a great way to put that, for sure. Positive expected return, but you're dead if you go negative, basically, essentially.
Correct. And so the opportunity here is if this is correct, and again, this is just empirical data that's showing these dynamics, and all I've offered is an explanation, I hate to use the phrase, but a narrative for why this is occurring. And I've tried to put a ton of empirical and fundamental data behind my analysis, but it is a hypothesis, right? So let's just be clear on that.
Right.
But if it is correct, then actually this change in distribution has another impact, which is that options are mispriced.
Yes.
So that's what we're doing at Simplify, is we're taking advantage of this dynamic to modify the underlying distribution of the market, taking advantage of this higher positive expectancy, recognizing in almost a Chuck Prince, when the music is playing, you got to keep dancing framework, that the underlying bias is towards higher markets. But at the same time, you have to protect yourself against the adverse outcomes.
The larger ones, for sure,
Right.
at this point. Yeah. And so that said, do you believe anything kind of turns the narrative around, Mike, from passive back to active, or you think this is just, I mean,
unfortunately, I don't. And so again, I would take people back to this line here, right? And so we hear this all the time, most recently from Kathy Wood and Elon Musk, right? That, eventually passive has to reverse, and we have to see share gain from active, right? It's become too large. The problem is there's no mechanism for that to occur, right? We've just never seen that. Through 2008, for example, passive gains share. It doesn't lose share, despite the fact that active managers' refrain is, during bear markets, we're going to outperform.
right.
Right. And the mechanics behind that are very straightforward. When you introduce dynamics like the 2006 Pension Protection Act, and you introduce things like qualified default investment alternatives, or you create things like the DOL fiduciary rule that effectively put advisors at risk if they offer their clients anything other than the cheapest, lowest cost passive vehicles, you effectively shut off the flow of funds into active strategies and continue to pile them into passive strategies, driving this market share gain that we're experiencing.
So do you feel like somebody, I believe you said once that you actually showed this data to the Federal Reserve or
Yep.
some of the regulators,
So
and
I
they
have
kind of
shared this with the Federal Reserve. I've shared this with the Bank of International Settlements. I've shared this with the IMF, Financial Stability Group. I've shared it with Treasury. I've shared it with everyone. And the simple reality is that, I'm a small individual representing a startup ETF firm. I have some, there's some knowledge of my work in the industry, but Vanguard and BlackRock actually spend more on lobbying activities than the rest of the industry combined.
right.
And the direct line that I got from the IMF was, we agree with your analysis, but Vanguard and BlackRock own the regulatory apparatus. And if we were to try to raise the alarm, all we'd do is get fired.
So I appreciate that you are raising the alarm, and unfortunately, it doesn't sound like there's anything that's going to be able to reverse this thing. Outside of, for allocators' sake, we have to look at kind of unique style strategies. Some of the strategies you guys are working on at Simplify, basically. Is that correct?
Well, I mean, that is the implication, which of course then, creates the opportunity for people to level charges that, I'm just speaking my own book, right?
Right.
There is obviously truth to that, right? That I have chosen to build strategies that will benefit if my theories are correct. But I would be absurd to do the opposite, right? I mean, I build strategies that benefit if my theories are wrong. Like,
Right.
I suppose that's a unique skill, but it's not one that I've figured out how to bring and create profits from.
Right.
But it is one of the key issues, right? Because it is very easy to dismiss these types of concerns as just yet another active manager saying, this is unfair and I should be able to charge more money, and people aren't giving me an adequate chance, right? Those are all tired arguments.
Yeah. I think one of the biggest takeaways is that the chart you showed on alpha, right? Just it's more of a mechanical thing. It's not portfolio managers becoming more dare I say stupid,
yeah.
right? Yeah. It's just it's actual.
I would just encourage, I mean, most of your listeners have kids, right? And so if your kid comes home and says, I failed a test,
right?
One of your questions is, well, wow, what happened? And if that kid then says, well, 95% of the class failed the test.
Yeah.
right? Your reaction to that is not, okay, you're grounded and you have to study more. Your reaction to that is, well, there must be something wrong with the test or the instruction methods.
Yep.
Right. And yet we accept that when it comes to active managers, where we say 99% of them underperform the benchmarks over time. And we turn around and we're like, oh, yeah, that makes perfect sense. That's not true. Right. The test is improperly designed. There's something wrong when we're that uniquely bad.
Yeah. That's a great way to put it. I've never thought of it that way. And that explains a lot of, and essentially this has happened since 2008, right? Where a lot of fund managers
portion of the share gain. And by my, the other component, I don't have this slide to show in this presentation, but there are very nonlinear characteristics here, right? So the initial introduction of passive strategies can actually be quite beneficial to a market, because what you've done is you've introduced heterogeneity into a universe, right? Or into an ecosystem. It's helpful to have somebody who has rules of engagement. If you give me cash, then buy. That makes it easier for me to sell, because there's somebody who's getting cash and constantly wants to buy, right? It facilitates liquidity. But just like the predator-prey dynamics that we've all seen in various things, like rabbits versus wolf populations or coyote populations, right? There comes a point at which the dynamics of the system become homogeneous enough, the predator becomes so concentrated that they lead to a collapse in the prey population.
Right.
And on that type of dynamic, it becomes very caustic and unhealthy within the environment. That's the point that I'm raising, right? That there are negative implications associated with the continued growth of these strategies. By my estimates, somewhere around 20 to 25% passive, inclusive, importantly, of that institutional space that is not reported in the public data, right, is a level at which we all benefit. But once we move past that point, the system becomes increasingly unstable and prone to collapse type activity.
And we're there at this point, right?
We're well past that point.
Yeah, well past that. So from a portfolio standpoint, the advisor has one of two things they can do at this point. They can go with the crowd, so to say, and continue down the passive line, go against the crowd and become more active. But then you have this issue of clients, right? Why are we continuing to underperform? And I guess there's actually a third option is you just have to structure the portfolios differently. The whole modern portfolio thing or Sharpe ratio, or not Sharpe yet, the CAPE ratio, Shiller's PE ratio, that all kind of goes out of the bucket at this point, essentially. If you're
unfortunately, it goes right to this chart, right, which is the dynamics of what. Sorry, give me 1 second here. The dynamics of what occur is a market that historically was mean reverting on valuation no longer is.
Yeah.
Right. And as you can see in this chart, and I just want to emphasize this, this orange line is what happens as passive gains share. You'll notice that I cut this line off because what it ultimately does is it shoots off the screen. And then when you try to take money out, the market collapses to zero. Right? Yeah. Now, I realize that sounds completely insane. The market's going to zero. But I've been through this before, and that is exactly what happened with the XIV.
There was a high vol day, I think, right? Or
wasn't even a particularly high vol day. As a matter of fact, the XIV went to zero on a day that had roughly the same level of volatility as we're seeing today.
Okay. Yeah. That's interesting stuff. That's where you kind of made your name, would you say, Mike? Or you were at Royce.
I've been doing this long enough that I've made any number of mistakes to get my name out in public. But yes, this was the event that I was delivering a speech at a derivatives conference in Las Vegas, and in the point of my speech was criticizing this product. The founder of the product was actually in the audience, got into an argument with me about how I didn't understand the product, and fortunately somebody actually recorded the argument, and that was released once my trade had paid off, right? So that's how I became notorious in the space, right? My own mini Big Short.
So that happened like 6 months afterwards. Basically, it went to zero or something. Is that
It
correct?
happened roughly 10 months afterwards. Yeah.
Okay.
And my calculation was that there was roughly a 95% chance of this product going to zero over a 2-year period. It ended up doing it in
10 months.
About 10 months.
Well, Mike, I really appreciate all the time today. I'm gonna wrap up with two kind of easy questions. Hopefully, that the first one I've always typically asked my guests is there a mentor in your past or an economic theory or an investment theory that kind of colors the way you look at investments?
Oh, I mean, look, I've been so fortunate to have so many mentors over time, ranging from all the way back when I was at the University of Pennsylvania Wharton School of Business as an undergrad. Gary Gorton, who was my finance professor, took me under his wing and allowed me to become his research assistant. Gary famously is the guy who blew up the world with AIG's derivative strategies in 2008. Mark Rubenstein, who blew up the world in 1987 with his portfolio insurance, was a mentor. On a very specific basis, the initial risk behind my transition to the buy side was taken by a guy by the name of Mitch Julis, who introduced me into the space, led to the sale of my first software company. He and Josh Friedman were, extraordinarily instrumental in taking a risk on me. And then, kind of past that point, obviously I'm very grateful that Peter gave me the opportunity to manage his assets and put the faith in me to take an outside sort of trade like this on. So I've just been, this industry actually is remarkably powerful in terms of mentorship opportunities. And it's one of the things I really try to focus on now is educating both my audience and, the younger generation, because one of the byproducts of things like the Volcker rule that have taken away the trading desks, the prop trading desks for many of the buy side firms, is we just have a shortage of people who are trained with the skill sets that are required for active discretionary management and the thought process, the training techniques that lead to the sort of analysis that I showed here.
Yeah.
So it's a very real risk. And it's something I really try to spend a lot of time on, is educating people to reflect all the opportunities that were presented to me.
Well, I, for one, greatly appreciate that because like I said, I've seen you on quite a lot of vlogs, and you bring a unique perspective to the market, in my opinion, that not a lot of people are doing that. So props to you. Where can people find you at, Mike? And another thing I wanted you to kind of throw out there, I know you're fairly heavy into charitable companies,
Charitable giving activities.
Yeah, charitable activities, I guess. Maybe give a shout out to some of the organizations you back or are part of, and so some of our viewers can kind of hopefully land and be a part of that.
Well, so I can link a couple of those together. Easiest place to find me, at least in the initial component, and find some of my writing and some of the work that I do, is to go to Simplify's website, so www.simplify.us, not .com, .us.
Okay.
There you'll find the products that we've created at Simplify, as well as many of the explanation of this, many of my media appearances. You mentioned the video logs or podcasts that I've participated in. Those can be found in the media section of our website. You can also find me on Twitter, which is becoming increasingly important within the financial services world. Confusingly, I'm at Prof Plum 99. And my avatar is the character of Vicini from The Princess Bride, the world's smartest man who dies in an intellectual combat of, battle of wits. I post fairly frequently both macroeconomic analysis as well as the work that I do there and links to it. And then you mentioned the charitable giving activities. So most recently on Twitter, I hosted a Spaces alongside my youngest son to benefit the Children of Haiti project, which is a project to provide this particular focus is on providing access to Western college education, higher level education, for skilled and talented individuals within Haiti that were orphaned during the earthquake. You can think about this as the same dynamics as the local villagers or the islanders pulling together to send Alexander Hamilton off to be educated, right?
Yeah.
It's underappreciated that while we can immediately go in and address the needs of food and shelter in the aftermath of an event like that, what's ultimately really necessary are improvements in healthcare, improvements in education to allow those societies to become increasingly self-sufficient and capable of participating in the world stage in a broad environment of what I would call human capital development.
Yeah.
I on my tweets, there are links to those organizations, and I for the next month through the month of May, will have permanently pinned there that participation. The other big charity that I'm very active with is a charter school in New York, where I raised my kids, at least initially, before moving to California in 2017. And that school, Coney Island Prep, was co-founded by a good friend of mine, Josh Wolf. It focuses on a very behavioral normative dynamic in education. So they began with a fifth grade class. They then expanded that each year, adding 6 so that the kids had continuity. We're now going into our 4th year of kids graduating from Coney Island Prep, which has expanded into both high school and back into early elementary school as the capability of the school has grown. Unlike your traditional public school, these kids live at the school functionally, right? So school day starts at 7:30. The school is available until 5 p.m., providing effectively full childcare facilities. The kids are in uniform. Instead of taking spring break, which we take for granted that we're going to take our kids skiing or we're going to go on a family vacation, most of these kids have no prospects of doing something like that. So the school actually will take spring break and vacation times and organize visits to colleges, for example, allowing them to see and model the behaviors that get kids to move forward in life that they may not have in their relatively impoverished household. Right. So it's just been an extraordinary success. Their graduating classes are attending college with 100% level. Right. So Wow. We're now in our 3rd consecutive year. Sorry, I'm terrible about this stuff.
It's
we're
okay,
now in our
man.
3rd consecutive year where every single kid graduating from high school from Coney Island Prep is going off to college. And so we raise funds to help those kids. We tend to take for granted that once a kid goes off to college, everything's well and good. Any parent who has been through this process knows that your kids are constantly hitting you for the little extras, right? Can I afford new clothes? Can I afford the books? Can I afford, the opportunity to interact with my peers? We actually are providing support to those kids through funds that are used to pay for many of those things that we take for granted in the requests that we get from our children.
That's amazing. So the kids actually stay at the school, or do they go home and
start in kindergarten and go all the way through 12th grade at the school? And when I say they stay, I don't mean they literally sleep there, but
right.
The school
Okay.
day starts at 7:30, and instead of being kicked out at 2 p.m.
right.
to wander the streets of Brighton Beach, they have the opportunity to stay for they stay for tutoring. There is no after school sports. It's purely academic. They have speaking clubs, etc. It's just a phenomenal recognition that one of the primary roles, and this is of course pre-pandemic that they recognize this, one of the primary roles of school is the socialization. It is the babysitting activities. It is the after school care that is so necessary and that we take for granted in our relatively affluent families.
Yeah. Well, that's amazing work, Mike. Again, thank you for coming on today and sharing all this data and this research that you've been doing. I encourage you to keep doing it. Like I said, there's probably thousands of me out there that haven't reached out to you that benefit from all this stuff that you're putting out there. And feel free to come back anytime. We'd love to have you.
Really appreciate it, Chris. Thank you so much.
Thank you, Mike.